Thanks to our friends at The Motley Fool for sponsoring this video. Check out the link below, fool.com/the smattering, to get access to the 10 best stocks to buy right now. Hey, everybody. It is all Buffett, all Berkshire right now here on the smattering. I'm Jason Hall. I got Tyler Crow here with me, and we're going to talk about two of Warren Buffett's self-professed biggest investing mistakes and the winner that more than made up for all of it. Tyler, the interesting thing about this concept is when it comes to Buffett, his two biggest self-professed mistakes, they weren't stocks that he bought that lost money. What's the one that comes to mind for you as the first one?
Like you said, there's obviously some ones but Berkshire Hathaway has lost money on it. But self-professed is like the ones that or at least one that he said he never did was buy Walmart, right? Shareholder
Eventually did, but didn't buy it.
when it was the little sparkle in someone's eye of just
Right.
a discounter in Arkansas sort of thing. But it's funny, it's just one of those ones. He's mentioned it a lot, which I find interesting.
Yeah.
It's there are lots of others, but yeah, Walmart seems to be like that college girlfriend that he really liked, but it just got away.
The one that got away. But it's interesting. And the thing to me that's so compelling about the Walmart story is twofold, right? Number one is it was during that period, and I encourage people to go read the Roger Lowenstein biography on Buffett because it really talks about these different periods of Buffett's career and life. And the Walmart one was really compelling because it was the time when Munger was really, his influence was still really taking hold for Buffett to shift from really focusing on value, trying to buy stocks at a discount to the value of their assets to build in that margin of safety and a price that even in a liquidation situation, you can make money, versus just buying the best businesses you can and figure out what's a fair value and being willing to pay that fair value, and then let management in the business that you acquired and all of the wonderful economics of that business, let that do the hard work. In Walmart, I think it was
Yeah,
like an eighth of a percent that he didn't, that the price, he was so disciplined on price that he missed multi-bagging returns. And that's why he says it was a big mistake, because an investment that goes to zero, you can lose 100% of your return. Missing out on a big winner, you're missing out on multiples of gains.
this was very much like you said, it was a different time where it was a lot more of a formulaic sort of investing style that he had
Mm-hmm.
back then, very greatly influenced by Ben Graham. I can see your copy of The Intelligent Investor on your bookshelf right
Right.
behind you. And
Right.
oh, God, look at that. It just
Yep.
happens to be
There
on
you go.
mine right there.
There you go.
But,
You're not a
you
real
know,
investor if you haven't bought that book. I think
yeah,
that's
maybe it just sits on your shelf, but it's there.
exactly.
But if you have read Benjamin Graham, it is like formulaic value.
You're breaking it up for its parts. What are you going to get for the parts? Yeah, it's
Yeah,
very much that. And that's the thing. And Buffett missed Walmart in the 80s when it was the growth stock to have bought, right, in retail. Missed it for that specific reason. Tyler, I want to talk about really quickly this second one, that this is the one that Buffett has said before was absolutely his worst buying decision. And that's Berkshire Hathaway, which, I mean, that may sound like anathema, but I think we need to explain the reason why, because there's a lot of validity to it. So let's start with this. What was Berkshire Hathaway versus what it is now?
there's no tie to anything related to Warren Buffett with the name Berkshire Hathaway. Berkshire Hathaway just happens to be, it was a textile company in New England because of the Berkshire Mountains in western Massachusetts. And Berkshire just happens to be the name of a lot of stuff in New England as a result of that. And it was a dying business. Textile manufacturing in New England was just not a thing that was seen to last.
Been dying since the 1800s, I think, is the key. It had been on in decline for a long time, Tyler, and it was actually the product of two struggling textile companies that had merged together with the idea of wringing out these efficiencies. M&A justifications were the same back in the mid 1900s as they are today.
Just hadn't come
Dealmakers.
up with the word synergy yet.
Exactly. The bottom line is that it started out for Buffett as a trade, and it was a good trade. He had figured it out. He'd buy it knowing they were going to buy back shares. That had just become the thing that they were doing. And he had a handshake agreement. It was a verbal agreement with the CEO at a price. The CEO lowballed him when it came time to do it. Buffett got mad, built a controlling stake in the business to take it over, essentially to fire the CEO. That's the short version of a more complex, long story. And here's why it was a mistake. And I think this is important because when Buffett took over a controlling stake in the business, it was a business that was very much in decline and was shifting from generating excess cash to getting to the point where it was going to be consuming cash. That meant that there was capital that was going to be required to maintain this dying business that could not be invested, as we've learned, which is Buffett's probably his biggest strength, is finding ways to use operating leverage to generate excess cash or using true leverage like insurance floats to reinvest that extra capital with that leverage to get big returns. And when you have a business that can't generate operating leverage, you miss opportunities and you can't generate excess returns. And that's why Warren Buffett says that Berkshire is his worst investment that's cost tens of billions of dollars in potential returns since taking it over in the late 1960s. Okay, Tyler. So that's the losses, right? Let's talk about a winner. And this should be pretty well known for everybody, but I think it's important to talk about this. It's so far Berkshire's biggest winner in dollars in terms of generating the best capital gains, and that's Apple.
We probably could have said Geico because Geico was the foundation that built being able to go after Apple and things like that. But yeah, like you said, on a pure dollar basis, Apple, despite the fact that it's not the longest term holding that this company has had. There's plenty of other public companies and wholly owned companies that he's had for considerably longer.
I think we're
But
talking 7 years at this point, not even a decade.
I think I've owned Apple longer than Buffett has personally.
I'm guessing you probably haven't generated
Nowhere, no,
$60 billion in capital gains on your
no.
Apple
But
stake.
But the point I'm trying to make is that the monstrous winner that it's been for the company in the dividends it's thrown off, the amount of gains that has been made in this company in 7 years, despite the fact that a lot of people saying, oh, Steve Jobs is gone. It's just going to be this, there's going to be no innovation. There's going to be no technology. Uh,
Berkshire didn't buy close to the IPO. Buffett could have bought in the early 2000s when we started to see like the iPod.
when Jobs came back.
Right, when Jobs came back. Didn't buy it in 2008, 2009 when it became clear that the iPhone was going to be a big one. Didn't buy it during any of those periods and has still generated tens and tens of billions of dollars in returns.
Just became an ubiquitous consumer product with incredible repeat purchasability and the ability to pass on incredible pricing power. And then branching out into all the things it has with services, with its additional products like the Apple Watch, which in its own sense is, despite initially saying it was a failure, is now a ubiquitous product.
It's a multi-million-dollar company on its own right.
AirPods are a giant multi-million-dollar company on its own.
Yeah.
And so that one is almost even befuddling when you look back and be like, this hasn't even been, it's a huge holding, but not a long-standing holding.
Yeah.
And still just an absolute monster.